Hey guys, Chad Larson with MLD Wealth. It is now March, and I want to jump right into it. We've been consistent and congruent with delivering some of our positioning strategies, market outlooks, updates, and trying to create content and around understanding what our viewpoints and thoughts are in volatile markets and on an ongoing basis. This month, I thought we'd do something a little differently, and I kind of hinted at it over the since the inception and launch of the podcast that from time to time I would bring on other partners externally and internally within MLD Wealth, within Canaccord. And this month I'm happy to introduce Travis Dowle from Maxam Capital. So thanks for being here today, Travis. And we're maybe first share with the audience a little bit of background on yourself.
Yeah, great to be with you, Chad. Thanks for inviting me onto your podcast. As Chad mentioned, I'm Travis Dowle. I'm the founder of Maxam Capital. We're an investment firm based in Vancouver. We manage two bespoke investment strategies for investors and advisors. Quick background on myself: started my career back in 1996 with a boutique in Vancouver called MK Wong and Associates. They were bought by HSBC a few years after I joined them. I stayed with there for the first 10 years of my career before joining a family office and then founding Maxam in 2009 and launching our first fund. So quite a well, everybody's going to think their own background's interesting, but interesting background, mostly on the buy side, but having worked for a small boutique and then a big bank and then back to founding my own firm from an entrepreneurial perspective. So decent perspective on the investment management industry over the years, plus having been through a few different market cycles as well. So it's been fun, continues to be fun.
Awesome. Thanks, Travis. One of the things, I really kind of wanted to, and we always talk with investors and private clients, our job is not to impress people. Our job is to impress upon people, some of the basic principles and philosophies in and around how we manage capital. But it's also important for people to understand, what it is when you engage with, I guess with MLD or hopefully with a lead asset allocator and multifamily offices. There's the MLD that people see and there's the MLD that people don't see. And foundationally to the success of our own business has been relationships and partnerships with quality people like Travis. I think so often we create emotional biases, investment biases, whether by ego, whether by fear, and it's important that we are constantly creating dialogue and creating thought leadership, and not just both to maybe revalidate our convictions, but also to create competitive thought and thinking, so that we don't kind of get over our skis too much and get down the wrong path. So Travis and I talk routinely, and one of the things I think thematically we've been explaining to Travis, we've been talking about for months, both in print format and since we've launched these video and podcast series, is talking about it's been over a year since the markets have made a peak, and we've seen a lot of volatility. And ad nauseum, we've talked about the Ukraine-Russian conflict. We've talked about supply chain disruptions. We've talked about the rising interest rate cycles, and and now thematically, investors' concerns are in and around, and went from inflation into the recession. And last month we talked about this was the most anticipated slow coming recession we've ever seen, and talking about how market lows are found along the way, but the low would be triggered by when the Fed kind of pivoted and changed. But I wanted to just kind of read an interesting quote and put it to you, Travis, to your thoughts. I think what's very interesting is I'm an economist by background, and I approach the world in asset allocation from a very top down focus. And Travis is bottom up focused, and where those things intersect, a lot of magic can happen. But the phrase, I think we're a lot closer to the bottom than we are the top. And I set the table for this. Looking at market corrections associated with recessions, Going back to 1957, the average time it takes to go from peak to trough and fully recover is on average 792 days. So the prior market peak being January 4th of last year, at February 5th, which is nearly a month ago now, that marked 396 days since that peak, or halfway. Past performance not a predictor of future results. More anecdotally, it would appear that the next 396 days, which we currently find ourselves in, stand to be better than the last. And I'd love some of your thoughts and comments of, what you're seeing in the overall marketplace, but more so, where you're seeing incredible opportunity.
Yeah, I think a lot there, Chad. I mean, it's been quite the ride since early 2020, the COVID crash. You hit the nail on the head and covered some of the main topics there in terms of what the market's been thinking about, what the market's been worried about of late. Everything from inflation, the Russia-Ukraine crisis, supply chain issues. We saw massive liquidity injected into the market during COVID as a response to that, to the global pandemic, obviously. And now we're seeing, it's still seeing some of the after effects of that. You quite rightly pointed out that our investment process at Maxam is very bottom up, and another way of saying that is we approach building our portfolio on a security by security basis, looking at the individual merits and thesis on a specific company, rather than a top down approach which looks at the world, then sectors, and then maybe individual companies on how to express a view. All the worries and challenges that you and I just bullet pointed there in our comments, I think are great for investors. There's a famous quote that you make most of your money investing. You make most of your money in a bull market or in a bear market. You just don't realize it at the time. And
Well
I
said.
always find it funny that when investors or what individuals, as humans, were bizarrely hardwired to be bad investors from an emotional perspective, hence the value of advisors keeping you invested. Time in the market versus trying to time the market. Humans, fight or flight, we get scared when something is going the wrong way, and we want to run away, rather than I think importantly looking at the value of a specific company or an investment and
What's
perhaps
really
buying more.
interesting there is, like, I haven't told this story like in print or video format, and so before I pursued my academia and economics, I went down the path in psychology, and thought I was going to solve everyone's problems on a couch. I enjoy sitting on one, but doing business coaching a number of years ago, down in the US, which I challenge kind of all advisors or operators within this business to get down into the US. They're just playing with a very different tool set, and scale. But we were working with this incredible coach down in Omaha. No, it wasn't Warren Buffett, but an incredible business leader down there. And he had us at an offsite with a group, and it was a data analytics and psychology think tank, and it was based out of Colorado. And they worked really with three groups. Predominantly, they worked with tactical response law enforcement, like FBI. They worked a very big contract with the NFL, working exclusively with quarterbacks and trying to make decisions under stress, and you name it. And then they worked in and around personal finance and decision making, much like how a heart surgeon has to make very strong decisions very quickly in an environment with a lot of things going on. But one of the studies was, and you teed it up so wonderfully, how we're wired improperly to make great decisions, especially during periods of stress, is that the emotional response, and it was a blind test, the emotional response to a sample of clients opening up an investor statement and realizing they have a bear market, which would be losses greater than 20%, had the same physiological response to opening their garage to go get a beer from the beer fridge and seeing an actual bear in their garage.
Yeah.
The cortisol rushing to the brain, your body's response is to shrink, not dilate those blood vessels to, save yourself from bleeding to get death if you're attacked by a
Yeah.
bear. But it's very
Yeah.
interesting. Our decision making goes out the window.
Yeah.
And again, back to
100%.
process. So tell me more
Yeah.
about when you're looking bottom up, because it's definitely something. And I had a really great conversation, and I promised him that I would use this in the podcast because I laughed out loud. Because we're talking about this market seems a bit Buffett-esque. It seems like security selection. There's incredible value as liquidity was presented as people rushing for the exits. There's some gems out there. And so I want
Yeah.
to hear more about your bottom up process, because when he came back to me about, something we discussed and implemented across portfolios, he said this looks like the prettiest ballerina in Moose Jaw. And
Hmm.
I thought that was pretty
That's good.
I thought that was a great analogy. So, a
Yeah.
shout out. I had to lay it in. So tell me more about the bottom
Yeah.
up
I,
process.
I love that bear in the garage comment. That's
Yeah.
fantastic. Yeah, I mean, again, sticking high level for just one quick moment, markets love to climb a wall of worry. And they have been of late, really since October, November last year. They've been climbing a bit of a wall of worry with broad markets going up. And once negative news is in the markets are generally pretty efficient and they reflect news relatively quickly. It's why you see markets bottom typically at the beginning of recessions or even sometimes a little bit before recessions, because they're always looking for, they're like, okay, things are going to improve from here. We love investing, certainly from a bottom up perspective per our process. During periods of volatility and after market declines, because I think that's when you see some of the most compelling opportunities. And I think, one interesting thing, part of our general thesis today, not just that there's good, attractive bargains out there. Obviously, we're trying to figure out where they are, which sectors and which individual companies to invest in, and I can speak to that. But I think what we're seeing is a shift in the market, and in terms of which sectors and which companies are going to be the leaders of the next bull market. I think it's highly unlikely that the leaders of the next bull market are the companies that led the last bull market. The last bull market that we just went through, let's call it the bull market post. We'll look at a shorter time frame post COVID. Again, was driven by low interest rates, by all the liquidity injected into the market. That brought about a very risk-taking environment by investors. I mean, hey, we're all sitting at home in our basements. Well, you and I weren't. We were staring at our screens, but people were sitting at home and they couldn't gamble on sports. They had more money in their bank because the government was giving it to them. And they weren't working, some of them, unfortunately. So, there was a lot of gambling happening in the stock market. I mean, there's record amounts of accounts being opened up at,
Robin Hoods,
yeah,
etc. Yeah.
exactly, all that. I mean, and so very speculative risk on environment, low interest rates. If you plug a low interest rate or a zero rate into a DCF valuation model, you can get very attractive valuations for companies whose earnings are far out in the future. So we've termed these, or the market has thought of these as long duration equities, i.e. the revenue growth is high, the earnings are far out in the future, as opposed to a short duration equity. And that's a term that I've sort of co-opted from bonds, but a short duration equity where there's current earnings that are happening now or very soon, and real revenues right now, not far off in the future. So those companies, short duration equities, had done very poorly relatively, coming out of the COVID period with all the liquidity injected, and the high duration equities had done very well. I think we're seeing a shift there where, again, those high duration, long duration equities, speculative tech stocks trading at crazy valuations are not going to be the leaders of the next bull market. I think that's largely due to capital having a cost again. We've seen the dramatic rise in interest rates through last year, a little bit early this year. Sure, we're probably on a pause for the time being now while the central banks wait and see what happens. But I think we're seeing a shift in the market where value and fundamentals are going to outperform, speculative meme stocks, let's
And
say.
momentum, yeah.
And yeah, and momentum. I mean, momentum's great, growth is great. We love those things, but we want to pay an attractive price for it. Um, and I think the current period is somewhat similar. There's a few historical periods we can look back to, but for what I'm chatting about right now, I think the current period is going to be similar to the 2001 to 2005 post tech bubble blow up, where again, highly valued companies, that had their valuations pushed to the moon through speculation, underperform, and you have strong performance from companies again with real quality, good, attractive valuations associated with them. And so I could envision a scenario where the broad markets, kind of like that '01 to '05 period, meander along. Sure, they could be positive. I think, investing after declines like we've seen is always a good thing broadly. But I think that leadership is going to change. And that's what we're focused on from a bottom up perspective is, to specifically get into your question in terms of our process on the bottom up side, what we look for is, or are companies where we think we've identified attractive fundamental value. And so that could be a company trading at a standard attractive PE ratio, a high free cash flow yield, paying a nice dividend, all sort of that basic, Buffett-esque type of stuff that
Yeah.
a lot of people chat about. But we will also look for hidden value in companies. Is there something specific with the balance sheet? Is there a new product being launched that we think is going to be a driver of earnings? Is there a management change, and that manager, the new CEO, is going to focus on margins, which is going to be accretive to the valuation picture and future growth of the company? So it's value either apparent in the multiple the stock's trading at, in something sort of more hidden with the company that I've described. Plus, we
Do you
want to find a
find, can
catalyst. So,
I'd love your thoughts on this topic because, as we've kind of gone back to, I've been talking for months and, because of, the podcast rules and again, all the disclaimers that this is not investment advice, blah, 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 is, we're seeing incredible value. And I love that. I'll use that, the short duration equities. You're seeing phenomenal companies with robust balance sheets trading at single, under double digit turns on earnings with free cash flow profiles that, north of 20+%. And they've started to move, which is amazing. And so we continue to kind of back to where we talked about being ahead of consensus and then pressing your bets into in consensus. Do you find, and I try to, Canada's a unique marketplace, like it's not the most efficient market, but the efficient market theory would suggest that news is disseminated very quickly.
yeah,
Price action comes when you're looking at, and I found some of those quant screens that would, for a long time, factor based investing became topical, and it was seemed more salesy after a while because putting simple algorithmic screens to say this stock's cheap, sometimes things are cheap for a reason, and the market's
right.
generally pretty good at pricing in that. So I'd be really
Mhm.
interested to know, and that was really compelling, and I think people would like to hear more about. It's really the roll up on the sleeves to understand both at a management, aside from just a balance sheet, but at a management and product line and kind of, I guess, consumer demand shifts, is where kind of like outsized returns can be found. Is that pretty accurate?
Um, yeah, I mean, we'll look at the fun part about my job and what I love about it is we can look at so many different things. Core to our approach, and I think specifically answering your question is, um, you know, we look for value. We're fundamental oriented investors, so we're analyzing the business. Does it trade an attractive valuation? Is it a quality company? But to your point, we don't want to get stuck in a value trap. Something that's cheap might be cheap for a reason. So our core long positions I would describe as, and we have through our materials over the years, as value with a catalyst. So we're looking for that value aspect of the company. And I'm a believer that values in the eye of the beholder. Where I see value, you may not see value, right? And that's part of what makes a market at the end of the day. There's always a buyer and seller on either side of the coin.
Yeah.
But we also want to find a catalyst or event associated with our investment thesis so that we don't get stuck in a value trap. And that's what keeps me engaged in this job and loving it, is because there's, quite frankly, there's always something to do out there. There's always new things changing and happening with companies. We're grounded in valuation the way we look at things, but again, we don't want to be stuck in a value trap. So there has to be something specific with our investment thesis. Again, whether it's new product launch, whether it's management change at a company that has a new focus, it's M&A, it's spinning off an asset. It could be a number of unique things, but we want to find something associated with it's going to drive that value. And it's fun. Those things are always happening. And that's what, that's core for our approach.
That's amazing. I think that gives a lot of insights. The not letting you off the hook quite yet. I wanted to spend just a minute or two, as we try to integrate other capital partners and thought leadership from people that I respect. People want to know kind of, I guess, some of the things that in our outlook and how their position, capital is positioned. Spoke to it a bit last month, and so Travis, appreciate being along for the ride. Something happening differently outside of the equity picture, was some I don't want to say material, but structural repositionings within our fixed income exposure. Depending on risk tolerances, liquidity needs, etc. But a component of liquidity generally makes up some portion of a client portfolio, both to have liquidity to fight the fight, more opportunities present themselves. Last year being very tough, we navigated it incredibly well. Bounced again, going back, and this was I made a golfing analogy. The statistics out of the US last year was a balanced investor. The benchmark was down just a fraction, a shade under of minus 20%.
Yeah.
So if you were along with a generic 60-40 approach, you got crushed. And again, being respectful that relative returns don't fund retirement goals and work optional lifestyles and new Porsches. It's important to understand that investing over the long term and having a disciplined process and understanding that, exactly to what you said, you make all your money in markets like this, you just don't know it at the time. I'm really excited about it, and I want to come back to you and ask you about, call it that institutional manager risk indicator of your comfort levels. But within the fixed income perspective, let me come back there, was the analogy was in risk management across a portfolio was that if this is a long par four, last year our strategy was off on the side of the fairway, and still on the shortcut. If you rode the market in a do it yourself or a generic 60-40 and you're minus 20, you're very close to OB. You're in the second cut of the long, or and you probably have a tree or two in front of you and are going to need to carry the water to
Right.
try to make that green in two.
Yeah.
So it was happy to start the year, and I still feel like it's the front part of the year. I can't believe it's March already, but still have very clean line of sight to the green approach. I made a comment last month kind of gearing up for Super Bowl, and I said go Eagles, so I lost that one. But so there's I went from football to a golf analogy, and we'll see what it'll be next month.
Yeah.
But the analogy in and around on the fixed income side was, as we saw, the percentage of US Treasury yield curve inversions hitting a new peak, and the 2-year Treasury bumping against 4.72 now. And, albeit the Fed turned a bit dovish, and we probably see another hike or two Consensus is almost leading into potentially 2 cuts into the end of the year. That pivot to the Fed will probably mark, that absolute low. So we
Mhm.
started the year in our outlook saying, we're constructive for the year, that it'll be a choppy front part of the year with a lot of volatility. And into the back half of the year, we were pretty confident that the market would start to discount the recovery we see in 2024.
Right.
That's all happening, and reminding clients and investors that, and then I'd like you to talk a little bit about how you invest capital. Is that I try to tell people, portfolios are not like light switches; they're like taps, and you try to flex your risk and your long and your exposure, because
Mhm.
if you miss January, January was one of the best Januaries we've ever seen. But now we're kind of in the weeds of it. I feel
Yeah.
like it's going to be sloppy and sloggy. We still have a lot of liquidity across the portfolios. I've referenced twice, but haven't got to the punchline. On the fixed income side, we have added duration, which killed people last year. And really looking at it's not so much an if, but a when scenario. When we see normalization into yield curves, whether I'm not saying it's tomorrow. It's not my job to make day by day calls.
Yeah.
The What I explained was the short rate versus the long rate is that what I'm giving up in yield to add duration seems trivial compared to the leverage that we will see, when yield curves normalize. I'm probably giving up about 125 basis points of carry yield for that risk-free rate, but the leverage that we get on the outside of the 20 and the 30-year bonds is going to be, I think, structurally a very unique trade that comes across. So that's something I wanted to highlight. Is we've
Yeah.
talked at a holistic level about how we approach capital. We talked about energy a little bit, and I know you're not so much sector calls. Energy was the best performing thing last year, and I keep saying I'm short-term bearish, long-term very bullish. Global recovery and growth, lack of
Yeah.
investment based on
Yeah.
ESG topical headwinds and companies' inability. We saw, I don't want to call the company out. It's one of the major global players, but recommitting or kind of coming back to reinvestment after years of
Yeah. I
publicly
saw that.
talking about that. I think we know what we're talking about, and anyone can call
Hmm.
me directly, but it was one of the global major players that the only
Yeah. It was
press release.
BP. Yeah.
Yeah, it was BP.
Yeah. Yeah.
You said
Yeah.
it, not me, but
Yeah.
for years, basically
Not a
saying,
reco. Not a reco. Just naming it
yeah,
when
it
you
was
said
just,
that. Yeah.
it was
Yeah.
just, listen, remember, you can imagine that, a big chunk of our investors are based in our demography.
Sure.
Home base is here in Calgary.
Yeah.
The energy thing's been in topical as of lately. In kind of not closing, but in kind of like the last segment, what I'd say from a risk sentiment, are you a nervous Nelly? Are you a raging bull? And also, what are they? I always ask, what is your biggest fear, and where do you see the biggest amount of upside? And again, not in a name specific thing, or what are the things that keep you up at night, in a good and a
Yeah.
bad way?
Yeah. I mean, that's a lot there. I'd love to comment on all those things. Um, I would describe myself and always have, and I've learned this about myself over time and experience. I'm a skeptical optimist, which I think is, I mean, I've got a bias obviously, but I think that's a good thing from an investor standpoint. We look very carefully and skeptically at individual companies that we use to build our portfolio. But I'm an optimist, and I think you should be an optimist when you're an investor, because if you're not, you're going to miss out. Markets go up over time. We know that. You should buy the markets when they're down. They're down. Do I think you should just broadly buy everything in the market? No. I mean, part of our strategy, as I discussed and alluded to a little bit, is we look for value, we look for catalysts associated with the companies, different event driven situations, sort of unique things. And you touched on the fact that I think a fact that the Canadian market is probably less efficient than other areas of the market. We love looking beneath the surface of just the biggest companies out there, which there's lots of great big companies out there, but there's also a ton of very attractive small and mid cap companies out there. And just because they're smaller does not mean they're higher risk if you look at their actual business and what they're doing. Yes, there's a different liquidity profile sometimes, but that's to me where some of the most attractive investment opportunities are beneath the surface. And that's part of the value we add to allocators as we're looking and doing, potentially different things in them. And we're trying to find these inefficiencies in the market. I wanted to touch, very briefly on your comments about the 60/40 portfolio and how bad it was last year with both bonds and equities being down, broadly double digits. One of our strategies is an arbitrage mandate. And I think with with the traditional 60/40 having a very challenged year last year, that's, I think, helpfully and self-serving, has pushed investors to consider, what, how they're diversifying their portfolios. How are they actually achieving real diversification, so that you've got, not all of your portfolio doing the same thing at the same time. And again, as you pointed out, that was a little bit of an anomaly, and I think it makes perfect sense what you're doing, adding back some duration on the bond side. Nobody's going to get the timing absolutely correct in the short run, but that makes sense. Our arbitrage strategy produces a yield like return, and it's very uncorrelated to the fixed income markets. I won't get into the specific details of that strategy here. A little bit about it. But there's a alternative strategy that the allocators can use to, and when that strategy was up last year, we were in the plus column last year in a year that was, crappy for basically everything. So it did its job providing real diversification. And I think there's a shift that's happening not just within the equity markets, but from an allocator's perspective. It's easier for allocators to utilize some of these alternative strategies and build a modern diversified portfolio.
Is that
And
is that is
that's
that also what makes you most excited? And again, thank you for giving me your time, and there'll be some details available about Travis's firm, etc. We have a heavy focus and inclusion on alternative strategies, private credit, arbitrage, etc. Because these are the years where people that actually work for a living are providing value to their investors for so long. It's dominated by large institutions that by default just get natural fund flow, and just a kind of the Ron Popeil food dehydrator, set it and forget it model doesn't
right.
work.
Yeah.
And so listen, I wanted to I'm going to wrap things up. We've spent a lot of time. It's really important to me, and I know our clients appreciate having time with thought leaders like yourselves and people that approach the market pragmatically with great process and insight, and their own capital invested alongside their investors. So with that, I'll publish some kind of the contact details and information with Maxam. But to my private clients and the listeners, again, thank you for your continued support and confidence. And we're going to go back to trying to ensure positive client outcomes. So with that, we'll close things up, and look forward to next month. And we'll be talking soon, Travis. And again, thank you for your time.
Thank you, Chad.